For this more advanced version of the NPV model, we are going to incorporate the income statement and see how depreciation and tax affect our analysis. So the first thing we're going to do, though, is revisit our process, and luckily the process stays the same in terms of read the problem twice and document the assumptions. Notice that the problem has changed in so much as the machinery now provides revenues of $20,000 as opposed to cash flows, and taxes incorporated. We also, for depreciation purposes, need to incorporate the fact that the firm's machine that it purchases, while costing $50,000, will only last for 5 years and have no salvage or resale value at the end of its life. So now let's go ahead and add on those additional assumptions, and I will do Alt-H-I-R, if I can press it properly, Alt-H-I-R to insert some rows. And so what we want to document are these specific assumptions as related to the machine. It has a useful life of 5 years. It has a salvage value of $0, as well as a resale of $0. Let me just expand my column here, make it a little bit wider so we can see things a little bit better. So now let's add a new section onto the building the Excel model piece, which is to say, in the building the Excel model piece, the first thing that we're going to want to do is build an income statement including depreciation and taxes. After we've done that, then we will wire the model to the income statement. So let's insert a bunch of rows down here and add on the income statement and see how that's going to affect the Excel model that we previously constructed. So let's give it a title. This will be our income statement section. And the basic construction we'll use for the income statement looks like this. And I highly recommend that you memorize the following layout. Revenues, cost of goods sold, gross margin, operating expenses, EBITDA, also described in the chapters as earnings before interest expense, taxes, depreciation, and amortization. It's from here that we will layer in the depreciation expense. The line after that will be called EBIT. If necessary, we can add in the addition of the possible needs to borrow capital to obtain the equipment. EBT is often called taxable income. We need a few more lines here. We here will incorporate tax then to finally get to earnings, or what we've often called net income. So let's widen this column up just a little bit more so that we can see everything. And now let's go ahead and work together. So the revenues that we have are now not cash flows of $4,000, but they are simply new sales revenues of $20,000 per year. So let's go ahead and bring those directly into our income statement. Cost of goods sold would be the cost of direct operating of the machines, or the cost of the goods used in the product, and we have none here, so we'll just make it 0. I'll add a line underneath to indicate a subtotal, because from here on out, everything we do will just be the previous number minus the one beneath it. So gross margin is simply revenues minus cost of goods sold. Operating expense would be any other new expenses like electricity or insurance, but nothing is indicated here, so let's just put a 0. Again, EBITDA is going to be a subtotal, so we'll take gross margin minus operating expenses. Now, here is where we have our first truly new addition to this problem. We will use straight line depreciation. Straight line depreciation, as the chapter discusses, is a very simple method of determining how much expense will be recorded every year on the income statement. The formula is going to be equal to the cost of the machine minus its salvage value divided by its useful life. Again, that's cost minus salvage divided by useful life. Now we're going to reuse this a bunch, so I'm going to go ahead and put F4s on all of these terms so that it will be easy for us to copy and paste. And now we see that annual depreciation expense of $3,000. EBIT then will be another running subtotal of EBITDA minus depreciation. Interest expense is not indicated, so EBT is just another rolling subtotal, so it's equal to EBIT minus interest expense. Alright, our last true new addition is tax. The formula for tax will be equals to earnings before tax multiplied by the tax rate, which I failed to include thus far, so I'm going to highlight this empty cell. Then I will go back and re-enter that assumption, tax rate. I believe the tax rate we put down was 20%, correct? So once we key that in, and we had the formula already pointing at that empty cell, we should see taxes of $3,400. So our last subtotal would be earnings, which is just the EBT minus the tax. I'll insert a row to give us some room. I'll put a double underline under there by doing Alt-HBU. And now let's go ahead and just make everything nice, pretty little dollar signs. All right. So now that we've got our income statement built, we have to go back and wire the model to the income statement. So here's the key. Our cost stays the same. Our inflows are now our revenues. You see those here. Our cash flows out are going to be equal to the 4 things that we've now included in the income statement. The first would be cost of goods sold. The second would be operating expense. The third would be interest. And the fourth would be tax. Notice we intentionally leave out depreciation expense because it is not an actual cash flow. So now that I have that there, and I know it's going to repeat itself, I'm just going to point to that $3,400 and copy and paste it across. So notice that our cash flows net are now representative of the new cash inflows, revenues, minus the new cash outflows, in this case, tax. But that tax piece also includes the depreciation allocation. Look what happens to this tax number right here if I'm to delete depreciation. We see it jump by $600 to $4,000. So depreciation is something that actually helps us save on our cash flows. Because we built our model nicely, we now want to go ahead and make sure that we've got everything pointed properly, and we see that we've got a wonderfully high NPV and an IRR that's absolutely off the charts at 107%.